Okay. And by the way, there's the recording for that part of chapter 4 that we were able to complete. And I'm going to go through now and go through this part of chapter 4 together. And I don't know why I hadn't been putting my computer in tablet mode before the class started. I sat there today saying to myself, what was my reasoning for not always putting it in tablet mode before the class starts? So if I do run into any bugs, it's before the class starts, and I didn't have a good reason. So anyway, so you don't have to worry about that tonight. Okay, good. So let's go ahead and let's take a look at, scared me right when I said that, then I looked up and I saw this note and I thought, oh, okay, I spoke too soon, but they're okay, so we're good. Okay, so let's go ahead and let's take a look at internal control communication. And there are 3 different internal control communication that we need to contemplate here, okay? One is when we are doing a straight financial statement audit of a non-issuer, okay, non-public company, and we are sitting there and we are not providing an internal control opinion. So there is no IC opinion, no internal control opinion. Okay, we're not giving an internal control opinion. All we're doing in this scenario is we're doing our audit. Okay, so we have to obtain an understanding of the internal control sufficient to evaluate the design of the control, determine they've been implemented, all that stuff we learned from chapter 2, 3. So we've done all that work. And so they tell us is we're here to give an opinion on the financial statements, but not to express an opinion on the effectiveness of the internal control. However, because we did all that work with the internal control, we may have identified deficiencies. And when we identify those deficiencies, then we are going to be required to communicate that internally. It's an internal communication to management and those charged with governance. That is covered under the statements on auditing standards. Okay, so we're doing a straight SaaS audit of a non-public company. We do all the work with the internal control. We're not going to issue an opinion on the internal control, but we may identify certain weaknesses, and we're going to have to report those internally to management and those charged with governance. Now, you come down and they talk to us about integrated audits, okay? And we could do an integrated audit where we're looking at both the internal control and the financial statements, both for public and non-public companies, both for non-issuers and issuers, okay? Now, when we do the audit of the internal control for issuers, this is where there is a required internal control IC opinion. We are required, okay? This was a requirement that was passed by the Sarbanes-Oxley Act, Section 404 of Sarbanes, said auditors have to give an opinion on the internal control. They have to as part and parcel of the audit of the public company's financial statements. So notice here, they tell us all issuers are required to have an audit of internal control of financial reporting that is integrated with the audit of the financial statements. And the standards for that are coming from the Public Company Accounting Oversight Board, PCAOB auditing standards. So all public companies have to receive an opinion on their internal control, part and parcel with their audit of the financial statements. It's in federal statute, and then the standards for that work are issued by the Public Company Accounting Oversight Board. Now, even though non-public companies are not required to receive an opinion on the internal control, they're not barred from doing so. So we could have an optional IC opinion. And there could be various reasons that a non-public company might choose to do this. One might be that they're planning to go public in some time in the near future, and they figure they might as well start that process now. And so if that's the case, an auditor may be asked to, yeah, you're auditing our financial statements, and so we want you will have to be the one that would also give us the opinion on internal control. They don't have to do this, they select to do this. And those requirements fall under the statements on auditing standards as well, under SAS. Okay. Now we're going to talk more about the second two, where there's actually an opinion on the internal control in A5. We're going to talk about that tonight as we get to A5. In this chapter, okay, and A4 is where we will talk about the reporting on internal control, the communication really on internal control that happens internally, where we're not giving an opinion, we are simply communicating when we identify certain weaknesses, and we are communicating that to management and those charged with governance. Okay. Any question? Three different scenarios here, right? Three different scenarios. We're going to talk about this scenario up here right now, and then we're going to get into the other two when we jump into chapter 5 in a couple of minutes. Okay. Now, before we start to talk about the specifics of that first situation, the no opinion on internal control, we do need some definitions that are actually relevant across the three different scenarios. Okay, so we have three different potential types of control deficiencies. Okay, so you have a control deficiency. Control deficiency means that there's a problem with the design, the implementation of the internal control. Do you think that's good when that happens? That's not good. Okay, so let's just put down next to that, not good. Okay, now you come down and you could also have a significant deficiency. A significant deficiency is bad. And then a material weakness is the worst thing. Okay, so you have control deficiency, that's not good. But what then things can get bad, and that's a significant deficiency, and then you can have a material weakness, which is the worst situation. Now let's just look first at the definition of material weakness. Material weakness is a deficiency or combination of deficiencies in internal control over financial reporting, such that there is a reasonable possibility that a material misstatement will occur in the entity's financial statements and will not be prevented or detected on a timely basis. When they say reasonable possibility, that means it is greater than 50% chance. In other words, they are telling you it is going to happen. There will be a misstatement in the financial statements that will not be prevented or detected by the internal control. It's greater than 50%. That means it will happen at some point. Okay, so that's a bad situation. We don't want that. That's the worst that can happen. Now, they talk about significant deficiency, and it's a combination of deficiencies or a deficiency that is less severe than the material weakness. That's why we showed you the definition of material weakness first, because you really got to know a material weakness to know a significant deficiency, right? So significant deficiency is kind of like material weakness's little brother, little sister. Material weakness caused all kinds of trouble in school, and now here comes significant deficiency. Aren't you material weakness's little brother? Yeah, I am, right? Okay, so it's bad, but it's not as bad as the material weakness, but still merits the attention of management and those charged with governance. Therefore, we have to communicate it. Okay, so you have control deficiency, you have material weaknesses, you have significant deficiencies. Material weakness and significant deficiency must be reported to management and those charged with governance. Control deficiencies, we're going to still have to report them to management, but we don't have to go up to the board of directors, those charged with governance. Okay, question?
Yeah, can you give an example of a material weakness that you might have seen in your career at some point, if you can think of one?
Material weakness and internal control, yeah. I was on an engagement looking at the House of Representatives Child Care Center. and they had no general ledger.
Sorry.
Yeah,
Yeah.
no, awesome. Okay, but that's probably not the best example. I've had material weaknesses, but they weren't necessarily in financial statement audits, and so we didn't have to call them out as an internal control weakness. But for example, um, the Department of Housing and Urban Development is supposed to monitor housing agencies. And what they would do when they get their financial statements is they do a set of analytics on them. But the analytics were the same kind of analytics that were done by the auditors of the financial statements. I mean, they just reproduced the same analytics. Meanwhile, they were missing critical items that you could have done some analysis to see if there were problems with the way they were managing the housing agencies. For example, there was a line item on their financial statements that showed as a liability, and they called it outstanding checks. And what it was checks where they had written checks in excess of the amounts available in their accounts. And HUD was doing nothing to analyze that account. And so what we did, we went through and we ran a analytic across all 3,100 housing agencies, and we found over 300 that even though HUD's mechanisms showed that they were in good financial condition, they were bouncing checks. And so HUD obviously, even though we didn't issue it as a material weakness, they had a material weakness in how they were monitoring the housing agencies because they were missing an obvious glaring thing there. So, you start running into things of that nature where you're like, wow, you can't go on like this. So, the other financial statement audits, material weakness that was on the public debt audit, now that I think about it, they had a problem with and this was a financial statement audit issue. They had their main and their backup in the same building. Meanwhile, that building, the Ohio River ran behind it. So, we were like, guys, you gotta move that. You can't have, so that would be a material weakness, right? Because they're risking the not only of their financial statement, but their ability to operate, it was being affected by that. So these kinds of things would be
Okay.
the material weaknesses.
Thank you.
And of course, after we end class tonight, Kathy, I'll think of like 10. But those are the only ones I can think of at the top right now. But okay. All right, good. So these are the kind of things, but they're big deals, right? I mean, material weakness is saying, and I almost went back to the definition when you asked me until you mentioned that I saw. The example is it's going to result in a material misstatement in the financial statements and not be prevented or detected. They're telling you this bad thing. The whole point of our audit is to detect these things, and the whole point of the internal control is to, now when we say detected, let me be careful there. We're not saying not detected by the auditor, okay? Because we have to design our procedures around our assessments of the controls, right? We're saying not be detected by management, and so it's a major concern. Okay. Okay, good. So when we go through and we're trying to evaluate whether a deficiency rises to the level of a significant deficiency or a material weakness, okay, we have to look at them, and we have to look at them both individually and in combination. They have more than weakness to determine where they represent significant deficiencies or material weaknesses. And when we look at that, we look at the likelihood, how likely is it that there'll be a misstatement, and what will be the magnitude of the misstatement. And that makes sense because we're saying that it's what reasonably be possible that there'll be a material misstatement. So magnitude would be, hey, it's material misstatement. Likelihood would be when we start getting to that reasonable possibility. Then it becomes a material weakness. It's not quite that severe. It's a significant deficiency. And then, we use some judgment in all of this, but to determine whether it's just a control deficiency, which none of these things are good. Okay. Now you come over and you take a look at communication. Okay. Now just keep in mind, guys, This is for non-public companies that we're talking about here. And we're talking about this first situation, right, where we're not giving an internal control opinion, and they're talking to us about the things that we should communicate internally to management and those charged with governance. What are our responsibilities to communicate internally? Now, the way Becker kind of did this is they finished the discussion for the first scenario with non-public companies, and then they get into the second scenario with non-public companies with the optional internal control opinion, and then they get into the public companies in the next chapter. They really could have handled all the internal communication right here. Okay, because later they kind of start losing themselves and weaving in and out of the opinion communication versus the internal communication. Okay, but right here, and I'll try to keep you on track with that as we go through. But right here, we're talking about internal communication. Okay, so they tell us that significant deficiencies and material weaknesses, even those that were corrected during the audit, must be communicated on a timely basis in writing to management and those charged with governance. Flashcard that. Okay, you've got to report those to management and those charged with governance. Material weaknesses, significant deficiencies. Previously communicated significant deficiencies and material weaknesses not corrected should be communicated again. And this is all in writing, guys. It's not oral communication. So make sure you put on your flashcard that these have to be in writing. So the auditor is sort of like a broken record. If they don't fix something the previous year, we tell them about it again. Okay. Okay, good. Now you come over and they talk about the timing, and they tell us that the timing should be by the report release date. When you say what report release date? The report on the financial statements, right? But they give us 60 days beyond. And I think a lot of companies probably take advantage of that 60-day period before they actually make the communication on the material weaknesses to management and those charged with governance. So the report is released. You got 60 days to, have this required communication up here. Okay. Now you come over and they tell us that management may decide to accept certain significant deficiencies or material weakness based on the cost that would be incurred to correct them. Even in those situations, we're still required to communicate the deficiencies in writing. Okay, and if they've all determined, they've all agreed, hey, we're just going to live with this, then so be it. We can't force them to fix that. Okay. Now, communication of other deficiencies. And when we say other deficiencies here, guys, we're just talking about control deficiencies. We're talking about the not good control deficiencies. So we've already seen what we need to do with significant deficiencies. Material weaknesses have to be reported in writing to management and those charged with governance within 60 days of the release of the audit report. For the not good other deficiencies here, the auditor should communicate to management only in writing or orally other deficiencies identified during the audit that are of sufficient importance to merit management's attention, but not significant deficiency or material weakness. Okay. If they are communicated orally, because it is okay to do so, and I see stupid CPA exam questions that test you on whether something can be communicated orally or not, which I find annoying because why do they have to test us on that? But anyway, if you do communicate it orally, then it must have been documented that you provided that communication. Okay. Okay, good. Flashcard that. It goes to management, not necessarily those charged with governance. If the auditor has communicated other deficiencies in prior period and management has chosen not to correct those deficiencies, the auditor need not repeat those. Okay, so those you don't have to repeat. The significant deficiencies, material weaknesses, you do. Okay. All right, good. Now they give us a little chart down here, but I've got my little one pager that I'm going to go through with you after we get into chapter 5, where I'll summarize some of this stuff for you because it's a lot of flashcards and rules there. But then I'm going to have also a one pager that's used as well. Okay. Okay, good. Now, the written communication of significant deficiencies and material weaknesses should include the following. So let's flashcard this. Since we know we have to provide a written communication, I guess we better know what needs to be in that communication. So we will have to give a definition of the term material weakness, and when relevant, the term significant deficiency. The reason they say when relevant, if you don't have any significant deficiencies, then you don't have to give the definition. And there's really not a special definition of significant deficiency. It says, well, it's not as bad as those other things, but it still warrants the attention, right? It's not as bad as material weakness, but it still warrants attention. So if you don't have significant deficiencies, you don't have to provide the definition. You always have to provide the definition of material weakness because the definition of significant deficiency relies on the definition of material weakness. So even if you don't have material weakness, you still have to give the definition of material weakness, okay? A description of the significant deficiencies and material weaknesses that you identify, whatever they are. And then coming down, the potential effects that can be described, okay? Material misstatement, potential effect. Hey, maybe there was no material misstatement. There may have not been a material misstatement, but we are saying there's material weakness, and we can talk about potential effect, okay? We need to let the, put in the opinion that we are there to express an opinion on the financial statements, not the effectiveness of the internal control. And then the report is restricted to management and those charged with governance. And then there may be some government authorities and whatnot that have a right to see that, but it's restricted. Okay. Okay, good. Now there are also some optional communications. Okay, so we've seen what we've had to put in there. That's what was up there. Did I tell you the flashcard? Just flashcard the things I highlighted there. And then for the oral optional, communication. Okay, we may also communicate the following: a description of inherent limitations in the internal control. We may not report the absence of significant deficiencies. So you can't come in and say you have no significant deficiencies because we weren't there looking for those, right? Okay. We may issue a communication indicating that no material weaknesses were identified. Okay. So we can say that, but we can't say you don't have these things because we weren't looking for them, right? Okay. It's not an opinion. Management may prepare, so just flashcard those optional communications. And then coming over here, another flashcard: management may prepare a written response to the auditor's communication regarding significant deficiencies and material weaknesses during the audit.
Professor, may I ask a question?
Yeah.
So you highlight the auditor may not report the absence of significant deficiency. Does that mean the auditor need to report anything, look, deficiency?
You cannot put in the communication, they're saying report, which it's really internal communication. To me, the word report should thinking about external reporting, which it's not. It's an internal communication. And in this written communication, you cannot say in there you don't have significant deficiencies, you don't have material weaknesses because we weren't looking for them. So you can say we didn't identify any, but you can't say, you're not giving an opinion. You can't say your internal control is effective, you don't have any material weaknesses. If an entity, has a material weakness and we're giving an opinion, we'll be giving an adverse opinion. But that's not what we're doing here. We're not giving an opinion. We are simply communicating to management, and I should simply, it's a big deal, but we're communicating to management and those charged with governance, the significant deficiencies, the material weaknesses, but you can't say you don't have those things. You could say we didn't identify material weakness, but you can't say they don't have them because that's now an opinion. Because if you do identify one, then you'd have to sit there and say, hey, then you'd have to turn around and say, well, you have an adverse opinion because we found one material weakness.
Okay, Thank you.
So just to clarify, it's okay to say we didn't see any, but you can't say there aren't any because you don't know, you didn't look hard enough
You didn't do the work necessary to be able to say
to be able to
that.
say definitively there aren't any, right?
Potentially, you could be issuing this report and never have tested the controls.
Okay.
Okay, so you didn't test the controls, but you still identified significant efficiency.
Right, you stumbled on it by mistake or by luck.
No, it's not by mistake. No, it's
In the
not by
course of doing your
mistake.
other work, you noticed this thing.
You evaluated the design and you evaluated whether it had been implemented. And if either of those hadn't occurred, you may, if you didn't like the design or it hadn't been implemented, you say, we have a material weakness. I'm not going to test those controls.
Mhm.
Later, they tell us that for the opinion on internal control, you must have done some level of testing of those controls, but that's when we get into the other types of engagements. And then I just thought of material weakness. So I was on the audit of the Department of Veteran Affairs, and Department of Veteran Affairs policy was that they would, when they made a payment to a veteran, they would bounce the payment records against Social Security's payment records if the veteran was receiving pension benefit, because your pension would be offset, or your Social Security, your pension would be offset by Social Security that you got. So they wanted to see if you had got some Social Security so they could offset your pension against Social Security. If it was a compensation payment, compensation is a veteran is injured in the war, they lose a leg, let's say. They compensate them for their entire life, regardless of how much money they make. It is the government saying, thank you for your sacrifice. And it's as crude as, if you lose the leg above the knee, you get $700. If you lose it below the knee, you get $500. They have a whole thing worked out. Well, what VA was doing at that time is they were not bouncing those compensation payments against Social Security records, because they're saying, well, it doesn't matter how much the person makes, they'll always receive that benefit. So we're not going to bounce our compensation payment records against Social Security. So I read that and I'm like, well, wait a minute, because they also said at the same time, they'll identify veterans that have died through this bounce against Social Security. Well, there is no benefit that continues after you die. Okay, the benefits stop. So I go to the clerk there and I say, can I have the file of the payments that continue to go out after people died? Not being told that there was such a file, and they go over and they go open a drawer. There's a file of payments that had continued to go out after people died. I didn't have to test the controls to find that. I could look at the design and know that this was happening. And so there, I didn't have to do any testing of the controls. I had to, and we didn't have to talk about potential effect. We had effect, which they had the payments that had been going on. That was a material weakness. The thing that was irritating about that is my supervisor kept trying to put in the report that we identified this by happenstance, because he didn't want to give me credit for having figured that out. He kept wanting to put in there by happenstance. When the report went up for review, the regional person that was over that work calls me into his office and he's like, what is this happenstance? And when I told him the story, he took that happenstance stuff out, and I worked directly for him after that from now on different engagements. So it's kind of funny, but anyway. Okay, turned out okay. Now you come over.
Thanks.
And, yeah, sure. And you take a look at the simple written communication, sample written communication. Guys, don't feel like, I know that it feels like because they put all these, examples of communication that you're thinking, oh, is this another report? we have to memorize or something? No. Okay, I just think that they were trying to fill pages or something. I don't know. We flashcarded the key reporting elements up here or wherever it was. Okay, wherever we did that on this previous page up here, we had already flashcarded the key communication elements, both those that are required and optional. And then, you know, you can look at that sample. Okay. Okay, good. Let's go ahead and let's take a look at a couple questions here. Actually, I just want to look at question 2 because we didn't talk about the material for question 1 here tonight, and I just don't want to try to go back, you know, so that came from some of the stuff that's on the recording. So just look at question 2. Hello, are you guys out there?
Yep.
Okay, let's go ahead, guys. Let's, you know, this is an interactive class. Don't get me into where I'm going to start calling roll. Okay, let's go ahead and let's call the roll, since I don't have a lot of students here anyway, so that's going to be a piece of cake for me. So I'll go through and I'll call everyone, see what they think. So what do you think, Andrew? A, B, C, or D? We can't hear you. Think you're muted.
Sorry, John, I just sat down. I don't actually even have an opinion.
Okay.
Sorry about that.
Okay. How about Tijal?
I answered, but I put D.
Okay, that's correct. D is the right answer, and I'll go through that. How about Catherine Caffrey?
I also put D.
D. Okay, good. Shannon?
I think it's D.
Okay. Nazim?
I did B.
B. Okay.
Yeah.
We'll take a look at that. Jane? Jane? Jane Trin?
I picked B. You hear me?
Yeah, I can hear you now. Yeah. You picked B?
Yeah.
Okay. Okay, good. And Stephanie?
I selected D and I submitted the poll.
Okay, okay, good. Okay, so guys, make sure you know you're participating good. It sounds like everybody, maybe somebody just forgot to go for an answer here, but most of you got it correct. The answer is D. Looks like we're about 60%. But let's go ahead and take a look at this one because I would hope we would have been maybe a little higher. But let's go ahead and take a look at this particular one. And an auditor's letter issued on significant deficiencies relating to, and we got to be careful that we know what kind of entity we're talking about here. Non-issuer, that means it's a non-public company. And of course, we were only talking about non-public companies during the discussion, but there, you know, on the exam, there could be also questions related to issuers, non-issuers, right? So you have to make sure that you know what kind of entity we're talking about during a financial statement audit, okay? And it should include a brief description of the test of controls. No, we potentially didn't even test controls, right? As I was saying earlier, we don't have to test the controls in an audit of the non-public entity's financial statements. B, indicate that significant deficiencies should be disclosed in the annual report to the entity's shareholders. What shareholders? What annual report? It's a non-public company. So B is not right. Include a paragraph describing management's assessment concerning the effectiveness of the internal control. You know, we're doing an audit of a non-issuer and they say observed during a financial statement audit. They're not saying it's an integrated audit. So it's not an integrated audit. So there is no requirement that management give information on the effectiveness of their internal control. We're going to talk about the requirements for integrated audits where you integrate both the financial statement audit and the audit of the internal control in a couple of minutes, and we'll see, yeah, then management does have to assess it, but they didn't say an integrated audit. They said during a financial statement audit. So no, C is not correct. D indicated the purpose of the audit was to report on the financial statements and not to provide an opinion on internal control. Yes, and that was specifically on that list where I highlighted and asked you to flashcard things that would be included in the report. Okay, question. Okay, good. Let's go ahead then and let's take a look at chapter 5. Okay, so we're done with chapter 4 now. Remember, if you didn't get a chance to look at the recording for that part of chapter 4 that we couldn't cover because of the internet crashing last time, to take a look at that. You also have, of course, the Becker videos as well. Okay. Okay, good. Let's go ahead then. And I'll tell you what, let's take 5 minutes just so that you can get chapter 5 out, I guess. I'm assuming you have it, but we'll do 5 minutes, a quick break, and then we'll take a little longer one during our kind of normal break time here in a little while. But let's go ahead and take a quick little 5-minute break before we jump into chapter 5.
Are you gonna stop the recording, John?
Yeah, I will, Andrew. Thank you. Remind me to start it again. While you're, getting chapter 5 material together, you might want to download that internal control communication document I showed you, so that you have that too. Okay, I'm going to go ahead and resume the recording. Hopefully you had a chance to grab your book for chapter 5, get that stuff ready. And Serena, did you want to say something else about the Ascend? You're muted. You want to unmute. You want to unmute, Serena? Okay.
Yes.
Okay.
Sorry, earlier I was not prepared for the sales pitch. So I want to make a sales pitch and encourage everybody in this everybody in the GGU University to try to join Ascend and GGU chapter, because it's brand new chapter, and there's few leadership position opening. So it's a great opportunity for everybody to network and also to learn how to run a small organization, because when we are going to the work field and we need this type of experience so we can get promoted. And also Ascend chapter is national, so we can get a lot of professional networking through this chapter. So I strongly encourage everybody to join this chapter, because it's not just a school. We also need to learn the professional networking here. So that's why I try to promote here. I mean, right now, I try to say we are so busy to study to pass the CPA, but this is only maybe just a short-term goal. But for our working professional, it's going to be at least 20 years, and we need to build up the networking so we can promote through our professional life. So I'm trying to sales this. Thank you, Professor.
Sure, yeah, for sure, Serena. And what's good about Ascend, like Serena was saying, is you have the student accounting group, accounting and tax club, which some of you may be involved with, but that kind of relationship really ends once you graduate. Whereas with Ascend, and I'm not discouraging from being involved with that group, but with Ascend, there is the after you graduate element, and so you start getting involved now, and it's a good association. And again, the membership is free, and as a member, then you can take advantage of potentially winning the raffle of the Becker material. So there is no charge for the membership. So to me, it's worth it to join. It doesn't cost you anything, and there's a chance that you could parlay, $1,400, something that's worth $1,400 for you to get the Becker material, even though you already have it. Maybe you have a classmate that you could give that to, or work something out with them. I don't know, maybe make them wash your car for a month or something. I don't know, in order to give that to. So, okay, all right, good. Now we're going to continue on with the discussion really of the internal control. And I mentioned in the discussion on attestation that these pages right here, okay, we're continuing the internal control, and this is a heavy area on the exam. We're talking 10 points. Okay, guys, so that is going to be heavy, the stuff that we've already started talking about, and the stuff that we're going to get into here as we now cover integrated audits. And I consider all of this one area here, these 1 and 2. Attestation standards, and the 3 areas of the attestation standards we're going to talk about here are agreed upon procedures. That's about 3 points. Prospective, something called prospective financial statements, and we'll get into that. That's about 3 points here. They didn't mention it outright, but actually that's probably more about 5 points, because we have both financial forecast and projections. So that's more of a 5. Okay, we'll talk about that. And then a little bit on reporting on controls at service organizations, probably about 3 points. Okay, and then reporting on compliance is probably a 2-point area. Government, 2 points, and single audits are really kind of, maybe 2 points, maybe 3 points. I don't know, fairly light areas. And I'm going to barely go through the text material with that, because I wrote a 3-pager that has everything you need to know about the government audits on there, since it's a fairly light area. Okay, so the big one here is what is continuing this discussion of internal control work. Now we're going to look at the other 2 possibilities, which
Question.
is what?
What about the you don't have points by attestation, engagements, and standards, or is that part of the 10 points Your bracket doesn't include the thing on page 31.
You know, I don't know, maybe 1, 2 points. I don't know, because they just start talking about some very high level things about the attestation standards there. And I don't see a lot of discussion about, you know, questions on the exam that deal with that particularly. Rather, they deal with specific types of attest engagements, which is the reporting on the agreed upon procedures, actually prospective preparation and examination of prospective and review of prospective financial statements fall under the STARS.
Okay,
So they're not attestation standards, whereas the examination falls under the attestation standards. And that's why they're here. So depending on the nature of the engagement, it could fall under different standards. So they're mentioning them here because they fall under attestation standards. So what I'm trying to say here is that they focus more on the specific engagements that fall under attestation standards than the general notion of the attestation standards, which is what is
Okay.
included there in that.
Got it.
So I'll say, maybe at 2 points where they might ask you something related to, specifics about the more generic things about attestation standards, but most of their focus is on specific engagements. Okay, all right, good. So we come over and we take a look at the integrated audits now. Okay, so remember, the integrated audits could be done both on issuers and non-issuers. If it's done for issuers, then it falls under PCAOB requirements, and we will have opinion on internal control. So that's that situation that, like we mentioned in the last chapter, that is the required IC opinion. Okay, and then you come down, and if we're talking about for non-issuers, again, they now call out the specific SAS, and this is what happens when we are going to give an opinion on internal control for a non-issuer. So this is the optional IC opinion. Okay, so you probably have a privately held company that's leaning towards going public. They're probably thinking, hey, in maybe 18 months or so, we're going to go public. So let's go ahead and start to get that opinion on the internal control going now. And so they go ahead and they choose to do that. They have to turn to the financial statement auditor and ask them to do that. Okay, in other words, it has to be integrated with the audit of the financial statements. You can't give, whether it's optional or not, you can't give an opinion on the internal control unless you have also audited the financial statements. That's why they're calling them integrated. Okay, question on that? Okay, so now we're talking about the other two types of engagements that we saw in the last chapter. Now they tell us that the objective of the engagement is to give an opinion on the effectiveness of the entity's internal control. Okay, so it's an assurance that we're giving on the entity's internal control. That's why it falls under, and it falls under the SAS, because you're going to be doing an audit of the financial statements along with that. Okay, or it falls under PCAOB audit requirements. Okay, so auditor requirements for issuers and non-issuers now. And guys, I will do my best to always make sure I'm making it clear to you when we are talking about issuers and non-issuers together, or when we are talking about them separately, because when the requirements change, then they start having a separate discussion. They kind of weave in and out of that. So if you get lost and you're not sure if I'm talking about a public company or non-public company, just say, which one are we talking about now? So that we kind of keep straight as we go through. Okay, so the audit of the internal, now we're talking about both of them together. The audit of internal controls should be integrated with the audit of the financial statements. The auditor should be the one doing both engagements. Okay, now the auditor should use the same control criteria to perform the audit that the entity used to evaluate the internal control. And the one that we typically use is COSO, the Committee of Sponsoring Organizations, the Treadway Commission's standards, which was those that, remember that 5 areas that we talked about: control, environment, the assessment, the control procedures, the information communication, and then the monitoring. Remember we talked about that? Becker called it crime, but I don't like to use the crime mnemonic because then they have it out of order as to how the steps actually go. But those are the steps, the 5 pieces, 5 components of the internal control. Okay. Notice here of COSO, and that probably is what you would use to evaluate that. Test of controls, okay, should be designed. Okay, so we have to test the controls. We don't have to in the no internal control opinion situation, right? If you're going to give an opinion on the internal control, which we said that's the objective of these other 2 engagements here, now they're telling us you must test the controls. Why don't you go ahead and flashcard these requirements here. Okay, now you come over and remember, guys, this requirement of tested controls is only for the integrated audits. That's integrated audits only, not the straight financial statement audit. Okay. Now, here we talk about issuers only. Okay. And they have to talk about issuers only here because there's a specific requirement under the Sarbanes-Oxley Act that states that management is responsible for establishing and maintaining adequate internal controls, and they must give an evaluation of their own internal control, and that is to be contained in their annual report. Okay, so the main reason that we talked about issuers separately here is what they're following under Sarbanes-Oxley requirements as public companies, and as public companies, they have to publish an annual report, right? As part of SEC requirements and whatnot. Okay. Now, you look at this and you say, okay, so I guess it's going to be way different for the non-public companies. And let's just take a look at this now. And I find it interesting that even though we have to talk about them separately because there are slight differences, I find it interesting that they're more the same than they are different, because what we do is we sit here and we create this same reporting bubble. Okay, I call it a reporting bubble. They say, hey, management has to evaluate the internal control. They have to give an assessment of the internal control. It has to be included in their annual report. And the auditor's opinion on the internal control also has to be there, right? Well, when you look down here, they kind of create the reporting bubble is what I like to call it. It's probably annoying, but I'm going to call it that anyway. Okay, the reporting bubble here that they create is sort of the same thing that was up there. So for non-public companies, management has to provide a written assessment about the effectiveness of the entity's internal control in a report that accompanies the auditor's report. So essentially, they're creating the same kind of reporting bubble that is legislated for public companies. They've created this down here anyway, right? Okay, for non-public companies. Okay, now the as of date should coincide with the date of the financial statements. And if management refuses to provide this assessment, you have to withdraw from the engagement unless there's some reason that you can't withdraw. And that could be the case. For example, GAO is legislated, is going to be the auditor of record of the financial statements of the federal government. That's the kind of engagement that GAO couldn't. How would you withdraw from that? It's legislated, right? So there could be something where you are legislatively called out as the auditor. You can't withdraw. That would be an example of that. Okay, but management's refusal to provide written assessment would be treated as a scope limitation. You'd probably disclaim at that point. Okay. Okay, good. Now take a look though, coming back up, the audit of the internal control can only be performed if management accepts its responsibility for the effectiveness of internal control, evaluates the effectiveness of the entity's internal control using a proper criteria. And here, the AICPA, they're a little bit, what's the word I'm looking for? Jealous, the AICPA. They get mad every time somebody else gets into a standard setting mode. and they want to say, hey, look at us, we have internal control criteria too that could be used. And so they kind of say, oh, such as the AICPAs here, because they're writing this requirement. So they mention their own rather than mention, COSO here, but you don't have to use the ICPA's internal control criteria. Again, most would still, you'd use COSO for public or non-public company. And then they have to support their assessment on the effectiveness of the internal control. Okay. And so why don't you flashcard these requirements of management? Okay. They have to what? Accept responsibility, evaluate the effectiveness, using the criteria, support their assessment, and then they have to provide written assertions about the internal control, and that information has to accompany the auditor's report. And so it essentially creates the reporting bubble that was contemplated by Sarbanes for public companies. Question? Okay, good. Now you come over and we come back to talking about them together, and we are going to get written representation. Now, we didn't get a chance to talk together about the representation, management representation letter for a financial statement audit. But what's happening here, so you should look at that lecture, but what's happening here now is they're saying, well, look, you're expanding the engagement. It's now not just an engagement to audit the financial statements, it's also an engagement to give an opinion on the internal control. So we need additional representations that relate to the internal control. So management's going to hand this letter to the auditor, right? And the auditor will put this in the work papers. Now I say management's going to hand the letter. Theoretically, that's what's happening. The reality is the auditor probably prepares the rep letter on management letterhead and says, here, sign this, okay? And then they put it into the work papers, okay? But this is something that is going to be, it's from management to the auditor, okay? And it's the same requirements, whether it's issuers or non-issuers. And they have, and we're going to flashcard what goes into this rep letter. Okay, management has to acknowledge their responsibility for establishing, maintaining the internal control, and state that they have performed the assessment. Management's assessment at a specified date, the criteria they use, probably COSO, confirm that they did not rely on the audit's procedure. Okay, if you run into a client that says, oh yeah, that internal control thing, yeah, tell us whatever you say, it's fine. No, they have to get off their, and they have to get in there and make these assessments, okay? State that management has disclosed all deficiencies in the internal control. If there's any fraud involved, they told us that. And say whether there have been significant changes from the as of date, right? Because maybe they did the assessment at the end of the year and they said, hey, we have these weaknesses, but that doesn't mean that they have to stand around and wait for you to finish their audit to correct them, right? So by the time you're issuing your audit report, there may have been some, changes to the internal control, okay? And then failure to obtain the representation results in a withdrawal or disclaimer of opinion. I would think if you're heading towards withdraw, but you're certainly not going to be able to give an unmodified opinion. Okay. Planning discussion, and I haven't seen a lot of questions that get into nearly the weeds that they're giving us here for the planning and performing the engagement, but let's just look at a couple where I've seen questions in your homework. It's a top-down approach, okay, and it's the same for both. So you'll look at entity level controls. Entity level controls include the control environment, potential for management override, the company's risk assessment process, centralized processing, flashcard that. Okay, remember, management has to assess their own internal control, right? And they do that at entity level. And then they'll do that at assertion level, okay? And it is very similar to what we have talked about. The auditor will look at assertion level controls, and it's very similar to what we've already said for the financial statement audit, but now we're looking at how these particular elements relate to the internal control, okay? So you can just go ahead and flashcard those. not a big deal there. Okay, okay, good. Now we have to test the controls. We didn't have to in a straight audit of the financial statements. Now, to support this opinion on the internal control, we have to test them. Okay, so you come over and why don't you go ahead and flashcard this pass key. I'm generally not a big fan of pass keys, but you know, just so we remember that you're looking at the design and the operation of the internal controls. And therefore, we don't need to remind ourselves of the COSO thing. We already did that actually. And again, I don't like that they go out of order here. You know, now I see it and now I can't help myself. The control procedures. This is why I don't have any friends. Okay, the control procedures belong up there. Okay, about friends. John, let it go. Oh, no, I can't. Okay, now you come over and you take a look at test of controls. Okay, and we have to evaluate the design of the controls. We have to perform walkthroughs, right? Just like we talked about in every audit you have to do when you're obtaining the understanding. And then you must test the operating effectiveness. We did not say that was required for, you know, an audit where we're not giving the opinion on control. Here, you must test the controls. Okay, good. Come over and let's take a look at the benchmarking discussion here. And if automated controls have not changed from one year to the next, you don't have to retest them. That's called benchmarking. These are automated controls. Okay, I say this because what? You know, computers don't break up with their girlfriend and have a nervous breakdown. So if they were working last year, they should be able to work this year. If it's a human control, hey, people have different things that go on and they may not function as well as, you know, from one year to the next. But for automated controls, you can use this notion of benchmarking. Okay. Okay, good. Now we have control deficiencies and we have to evaluate those control deficiencies. And it's the same for issuers or non-issuers. And you come over and you say a control weakness may be a material weakness, even if no material misstatement is actually found. So it's important. Well, I probably should have highlighted that. Let's just look right here. The auditor should determine whether identified deficiencies represent what? Significant deficiencies or material weaknesses. And it's the same definitions that we saw already. Notice when we talked about the definitions, it was before we got into the actual discussion of the communication for the straight SAS audit where we're not giving an opinion on the control. Same definitions are being used here. Okay, significant deficiency, material weakness, same definitions that we saw earlier. Okay, and a control weakness may be material, even if no misstatements actually occurred, and compensating controls, if tested and found to be operating effectively, may limit the severity on identified deficiencies and prevent it from being a material weakness. Now, I've heard it someone say a couple times, and I don't agree with it. And I'm not sure how to talk to this person and tell them that I don't agree with something that they say when they speak in my class. But I've heard people say, well, if there's fraud, it's not a misstatement because they still expended the money. And so it should be shown as an expenditure and it's not a misstatement. And I'm like, well, no, you know, there are some classification issues there. I mean, if they're saying money spent on, you know, equipment and the equipment is, you know, is stolen, it's not an expenditure. It's some sort of, so that could be a classification issue right there. It shouldn't have been, it's not in the equipment account and you don't just want to treat it as an expenditure and you should disclose things about fraud. So anyway, that's just kind of an aside, but anyway, I don't even know why I mentioned that. So let's just come over and look at forming an opinion on the controls. And it's the same for the issuer and non-issuer. So after forming an opinion about the effectiveness of the entity's internal control, management's report should, and this gets a little annoying because it starts out talking about what should be in management's assessment of internal control. Don't forget, management has to do their own assessment of internal control, and that's going to be part of their annual report. It's going to be in the document with the auditor's report, right? And they start out talking about the things that need to be in the report, and then halfway through they lose themselves and say what the auditor would be doing when they look at this report. So we can just look at this as a listing of things that the auditor will be looking for in management's report as they evaluate management's report. Okay, so let's just go ahead and take a look and indicate that management is responsible for the internal control. Describe the subject matter, which is internal control over finance reporting. Identify the criteria used. Again, it's probably COSO. Include a statement of management's assessment about the effectiveness of the internal control and an as of date. Okay, mostly the end of the most recent fiscal year. Describe any material weaknesses. Okay, then they start getting into, well, what the auditor does if they determine that there's something wrong with the report. Okay, so that's what I'm saying. Just look at this as a guidance to the auditor of what to be looking for in management's report on the internal control. If the auditor determines that required disclosures for one or more material weaknesses have not been included in management's report, the auditor should state that in the auditor's report and describe the weakness. If management's report is incomplete or improperly presents a weakness, then the auditor should include that in their report. And if management refuses to supply the report, the auditor should withdraw. Okay, and then if management report contains additional information beyond that noted above, the auditor should read the additional information to ensure that there are no material inconsistencies and disclaim an opinion on such information. For example, and I want you to include the example in your flashcard because they seem to be wanting to ask this question. If management, and I call this the WA rule, if management says, but the cost of correcting the deficiency would outweigh the benefits, auditor absolutely has to disclaim an opinion on that comment. That is not something that is part of the reporting structure for management's report. Okay. Okay, good. Question on that? So flashcard those things that the auditor needs to consider when they're looking at management's report, okay? And come over and let's take a look. I don't need a comparison of the two engagements because I already have a flashcard of that for you. I'm going to give you a worksheet on that here in a couple of minutes, but we'll look at that after we continue. They're going to give us a question now, and then they're going to take us into another module, which is really the continuance of this same conversation about internal control opinion on integrated audits. But let's go ahead and let's take a look at this question together.
So as a practical matter, if a company, like a company management is typically good at running their company. They may not be experts on internal control. Would they hire a consultant to help them make that evaluation potentially?
Sure, consulting engagement. However, if it's a public company, that's got to go through the board of directors.
I mean, maybe they would hire another firm, like let's say
Sure.
Deloitte was doing their financial statement audit. Maybe they would hire Price Waterhouse to help them figure out if their internal controls, help them with their assessment.
If they wanted someone to help with their internal control, it would have to be it must be somebody other than
Than their financial statement auditor. Yeah.
Yeah. Because otherwise, you're going to be evaluating your own work. at some
Exactly. No,
point.
that part I got. I just
Yeah.
was wondering because I was thinking about this and I thought, company management's they know how to run their website business or whatever. They might not necessarily have the experience to do that. I mean, they might have somebody in finance, but maybe that person's,
Yeah,
bandwidth challenged.
if you look at for the guest speaker, and I think Kathy, you probably already saw it, but for folks that haven't watched that, if you watch Danny Wallace's video, he talks about that very thing, how startup companies, that have all this tech knowledge and whatnot, and they make the mistake of waiting too long to bring
Right.
in some sort of accounting expertise. So yeah, absolutely, you would be wanting to either consult with someone outside, like you're saying, or you start to bring those people on board, right?
Yeah.
I had a colleague that his whole business was going in and serving as the CFO for companies that were sort of at that stage. And he would come in and do that as a CPA. And then, he would jump out once they were ready to go ahead and go to that next stage where they were going to bring on permanent folks as they started to go public. And so that was sort of his little niche in the accounting arena.
Okay.
Okay, let's take a look at this one now. Looks like everyone had a chance to try it. And okay, we've got a pretty good response here. Let's just take a look, though. Most of us got it right. But let's look at this one. And so in an audit of an issuer, the auditor must provide an opinion on which of the following. Well, the opinion is on the financial statements, and there's opinion on the effectiveness of the internal control. The audit committee's oversight, there's no opinion on the audit committee's oversight. Now, audit committee's oversight might be part of what the auditor considers in issuing the opinion on the effectiveness of internal control, but specifically the report is on the effectiveness of internal control. And of course, we give the opinion is on the effectiveness of internal control and the opinion on the financial statements. So the answer here is A, which 1 and 3 only. Okay. Question? All right, good. Let's go ahead. You want to break now, or you want to go ahead and keep going and take a break after we finish this internal control discussion? I'm going to answer my own question. Let's go ahead and take the break now. Okay, so we'll take a full 10-minute break now, and then we'll pick up with this next module here. Yeah, okay, now I've teased you enough with the break. Let's take it. Okay, and I'll pause the recording. Okay, guys, we're going to go ahead and continue on. I've gone ahead and resumed the recording. And so let's go ahead now and start to take a look. And first, we're going to look at the internal communication that has to go to management and those charged with governance. And we're going to look at them separately for non-public versus public companies, because there's some annoying minor timing differences and a slight difference in what has to be reported between the two. So they have more in common than they do not, but we're going to have to sit there and kind of go through and note a couple of things that are a little bit different. And then we're going to take that same approach when we start to actually talk about the opinion. So first, we're talking about the internal reporting of material weaknesses, significant deficiencies to management, and those charged with governance. And then we're going to talk about them for public and non-public companies. And then we're going to get into the opinion itself and what needs to go into that. Okay, so give me 1 second here. Okay, so it starts to get darker, then all of a sudden start looking like a head just floating in the middle of darkness. So let's just go ahead and let's take a look at this. Okay, so what happens? The auditor should communicate. Now, this is for non-issuers. The auditor should communicate to management and those charged with governance in writing all significant deficiencies and material weaknesses found during the audit of the internal control. Okay, including those remediated during the audit that were previously communicated in writing, but which had not been corrected. Okay, so this is just like what we saw for the reporting requirement for non-public companies in a non-integrated audit, where we're not giving an opinion on the internal control. Now, here's an important difference. Remember, we said that there was 60-day window for the communication. In that case here, such communication should generally be made by the report release date. By the time we're issuing our report, and now it's a report on internal control and on the financial statements, that's when we have to also have had this communication. Now, I think they're not wanting there to be this lag here, because now we're reporting things externally as well, right? And so they don't want a situation where you haven't reported it yet internally, and now you're starting to report it externally. So they don't allow for that 60-day window here, okay? They tell us that the auditor may choose to communicate significant matters earlier during the course of the audit, but does not negate the requirement for written communication, even if the deficiency during the audit. So you don't have to, it's not I have a surprise for you, material weaknesses, but I can't give them to you yet. You can give them right away, and they may get going on them and correct them, but you still have to report them, and they would still affect your opinion on the internal control.
So, Professor, I have a question. So earlier you say such communication generally should be made by the report release date, and you can mention about 60 day. 60 day is the limitation.
Okay, remember, we've got 3 types of engagements going on, right? One is you're just giving an opinion on the financial statements for a non-public company, and you're not giving an opinion on internal control. But you still have to report problems to management and those charged with governance. Significant deficiencies and material weaknesses have to be reported to management and those charged with governance. And in that type of engagement, they give us a 60-day window before we have to report it. If we're going to be doing an integrated audit, meaning that's still where we are, integrated, meaning we're still auditing the financial statements and we're giving the opinion on internal control. Now they tell us the communication to management and those charged with governance about the weaknesses, significant deficiencies, material weakness, have to be provided by the report release date, because now there's an external report that's going to be going out, probably talking about those various things. And we want to make sure that there has been the communication internally when that report is released externally.
Okay, thank you.
Mm-hmm. Okay, yeah, it gets a little hard to follow, guys, and that's why I was saying earlier, they could have put this over there with the other stuff in the other chapter, and I was thinking about telling Becker, hey, move that stuff over, but I don't know. They don't like when I say those kinds of things to them, so I've stopped saying them over the years. But anyway, okay, good. They give us the sample report. You don't have to, read through that. Now, all deficiencies. So now they're saying what? Those issues that are not significant deficiencies are not material weakness. Okay, the not good deficiencies should be communicated to management in writing. So you're going to have to report the not good control deficiencies that we talked about. And here they do give us a 60-day window because those things probably aren't affecting the opinion on the internal control. So they tell us what? Hey, report the material weakness, significant deficiency, report it, communicate it by the report release date. For those things that are not good control deficiencies, we'll give you a little more time with those. Okay. Okay, good. The auditor, if the auditor concludes that the oversight of the financial reporting and internal control by the company's audit committee is ineffective, the auditor must communicate that conclusion in writing to the board of directors. Thanks a lot. I mean, that's a tough one. Who hires and fires the auditors? So now you're telling them, well, you're not doing a very good job. And they say, well, neither are you. And they show you the door, right? So, you know, that's a tough one, but it's got to happen, right? Okay. Okay, good. Come over and take a look. And note here we say an audit does not provide assurance that all deficiencies less severe than material weaknesses have been identified. So the auditor should not issue reports stating that no such deficiencies were noted. The auditor should not issue reports saying that no material weaknesses were identified. Okay, so they're getting pretty tight on us here. They don't want you to be putting that kind of phrase in there. What we're going to have is we're going to be having an opinion on internal control, and that opinion on internal control stands on its own. And so they don't want you saying no material weaknesses, and you give the opinion and you follow the reporting format of the opinion. Okay, I'm not going to look at these summary charts because I have one for you. I'm going to show you here in a couple of minutes, but let's go ahead and let's take a look at now with issuers. And guys, it's an annoying difference. Okay, and I'll tell you what the annoying difference is. They don't tell, they tell us that we have to report material weaknesses, communicate material weaknesses to management and those charged with governance, and they tell us that you have to do that prior to the report release date. So that's one of the reasons we have to talk about, because in the other ones they say what, by the report release date. Here they're going to say prior. And then for the material weaknesses, and then for significant deficiencies, they don't give us a time frame for whatever reason. And that's the only difference that I can see between what we said for non-public and public companies here. So the auditor must communicate in writing to management, the audit committee, all material weaknesses identified during the audit. The written communication should be made prior to the issuance. So they're telling us material weaknesses, that's all they speak to there, material weaknesses, and they say prior. Okay, well, that's different than what we saw for the non-public companies, because they said by the report release date, and they included in that what the discussion of significant deficiencies. They tell us that we are required to identify significant deficiencies, no time frame. They don't say by the report release date, they don't say prior to the report release date, they don't 60 days. They say nothing about time when it comes to significant deficiencies. Okay, that's the major difference. Okay, the rest starts to become very similar. The auditor should do what? Should communicate to management in writing all deficiencies in internal control or financial reporting. Okay, those that are less than magnitude than the material weakness and significant deficiency, and inform the audit committee that such communication has been made. So you can go ahead and flashcard that is analogous to what they said about reporting all deficiencies for non-public company, where they gave us that 60-day window to report those. Here, they don't talk about a time. And then they make sure that you report that, make sure that those charged with governance know that that's been communicated to management. Okay. Again, if the auditor concludes that the oversight of the financial reporting and internal control is by the audit committee is not sufficient, you have to tell them that. And again, that's as you probably end up getting fired as soon as you end up telling them that. And then you come over and an audit does not provide assurance that all control deficiencies have or significant deficiencies have been identified. So the auditor should not issue reports saying that no such deficiencies were noted. Okay, flashcard that, but that's really the same. So again, when you look at, well, why do we have to talk about these separately? It's because prior, for the material weaknesses, no time frame for significant deficiencies, which they gave us a time frame for the non-public companies, and no time frame for the not good control deficiencies here, whereas they gave us a time frame for the non-public companies. They told us 60 days. Question?
Yeah, just a quick question on the impact to the opinion. So if you find a material weakness, that means that the internal controls are ineffective. That would automatically be an adverse opinion, or you just say
Yep.
they're ineffective?
Yeah, we're gonna go there
Okay.
in a minute, but yeah, it's
And if you
automatic, it
find-
results in an adverse opinion, one
Okay.
material weakness.
Okay, and if you find significant deficiencies or one or more, maybe that's a modified opinion? Or
No,
you'd say they're effective except for these things?
you would list, no, it's not an except for, it's not a modified or qualified opinion. One material weakness or a series of one giant material weakness or a series of deficiencies that culminate to the level of a material weakness.
That's adverse.
That results in an adverse, and there is no drop down.
Okay, so it's either effective or ineffective. It's binary. It's kind of yes, no. It's a
Yes,
toggle kind
correct.
of.
That's
Okay.
right. You know, and think about it. If you have, significant deficiencies sitting there, it's like, well, if you have enough of them, they're going to morph into a eventually into a material weakness anyway, right? So I think they're just saying, but let's keep it simple. Material weakness, adverse, that's it, just takes one. Or a series of not, significant deficiencies that together constitute a material weakness.
Okay,
That
so
result.
there's no middle ground of like, okay, well, they're effective except for the XYZ division,
Correct.
Okay, you can't do that. Okay, got it.
Right.
You'd have to
And
decide if the
I think it starts getting into, well, how bad is it before you have to give the adverse opinion? And I just don't think they want to start having discussions of significant deficiency in internal control and then saying, no, it's okay, except for the, they just want it to be, like you said, binary, yes or no. I think is
okay, got it.
that way. Okay, good. Now you come over and let's take a look at and again, we're not going to look at these summary tables because I have them for you already. So now reporting on internal control. So now we're talking about what? Now we're talking about the opinion. Okay, before we were talking about communication, right? The written communication to management and those charged with governance, that's internal. This that they're talking about is going to be in, say, if it's a public company, their annual report, or it's going to be published with the opinion on the financial statements if we are a public, non-public company. Okay, so they talk about them separately. I can't even remember why they talk about them separately, because it's almost the same discussion, but I can't remember what the reason was that they had to separate these. But let's just take a look. The auditor is required to report on both the company's financial statements and on internal control over financial reporting. And they can do that in two separate reports or one combined report. If they are separate reports, the two reports have to point to each other. So flashcard that the report on internal control has to point to the report on the financial statements. The report on the financial statements has to point to the report on internal control if they are separate, so that the users know that there's two reports out there. Okay. Again, you don't have to memorize these reports. I don't know why they have to give you the whole report here. Okay. But if you take a look, it is worthwhile stopping for a second here to see that there is a definition of inherent limitations. So even if we're saying, hey, the internal controls are effective, we still want to let people know that shit happens. Okay, it may be looking okay, but there could still be some problem that occurs, right? Okay, so it's sort of a warning. And so that's why when we come over to the next page, I want you to flashcard just so that you remember that they'll probably ask you a question on the exam. That's flashcard. They'll probably ask you on the exam about something dealing with the inherent limitations paragraph, which, okay, it's got to be in there. Okay. Okay, good. If it's a separate report, then, oh, I know why they had to talk about them separately, because in public companies and non-public companies, because if it's a separate report, then what's going to happen is you'll add a emphasis of matter paragraph if it's a non-public company. If it's a public company, we call that an explanatory paragraph. That's the main difference, okay, when you have the separate report. Okay, okay, good. And they go ahead and they show the opinion, and then they show them down here, putting that in inherent limitations. And then I guess this is this the separate report? This is the separate report. This is an example of a separate report. And if that's the case, if you have the separate report on the financial statements and internal control, okay? So this is the combined report, sample combined report, John. So this is if it's a separate report here. Okay, if it's a separate report, then you have to go ahead and you have to put this, and it would be a, I'm not sure if it's an other matters or emphasis of matter. They don't say here, I don't think. I'm not sure if it's an other matter or emphasis of matter. I think it's an other matters, because there probably wouldn't be disclosure in the financial statements about the report on internal control. So it's probably an other matters paragraph that you would put if you do separate report. If you combine them, then obviously they're combined. Okay, question? Okay, good. Come over.
Yes,
and
I have a question.
Mhm,
So,
sure.
in what situation you choose to use separate report or combined report?
You might want to use a separate report if there was some limitation, restriction on the use of the report on internal control. If for some reason there was some limitation on that, then you'd have to have separate reports. But other than that, I can't think of a reason that you would use separate reports. So typically they'll be combined. Okay. Okay, good. Now you come over and we look at the report date. And again, guys, we're talking about for non-public companies, and the report should be dated no earlier than the date on which you have the appropriate evidence. And the date of the report on internal control should coincide with the date of the auditor's report on the financial statements. Okay, go ahead and flashcard that second one. Now, Kathy, to your question, material weakness, okay, in internal control equals an adverse opinion. It just takes one. And there is no drop down from there. There's no qualified. It's either, hey, it's effective, or we're going to give an adverse opinion once we find one material weakness. Okay. Other considerations. If management report fails to include one or more material weaknesses, then the auditor should call that out in their report. Okay, and communicate this to those charged with governance. If management records includes a material weakness but doesn't fairly describe it, present it, that then the auditor would call that out in their report on the internal control. Remember, guys, we've got that reporting bubble. We've got management's assessment of internal control, and we got the auditor's opinion on internal control, and they appear together, right? Okay, and if there's something that the auditor doesn't like about the way management wrote up a weakness, or they didn't include a weakness in there, then the auditor will call that out as a problem in their report on the internal control. And of course, the auditor should consider the effect of adverse opinion on the financial statement opinion, right? I mean, if there's so many weaknesses that could ultimately affect the report on the financial statements. So flashcard each one of those additional points. Okay, reporting on internal control for issuers. Okay, and again, if we're talking about issuers now, the report on internal control, it could be two separate or combined reports. Separate or combined reports, they have to point to each other so that the world knows that the one the other exists. Okay, so if you're going to have that, then you're going to have to, separate reports. You're going to have to financial statement report points to internal control report and vice versa. Okay, and you can see the example here of the opinion on the internal control. Again, you don't have to memorize these. Just remember to talk about the limitations paragraph so that they expect you to know. The following paragraph with no heading should be added immediately following the paragraph if a separate report. So here they tell us, hey, there's no heading on it. So again, I think it's in other matters in the, didn't say? I find that irritating that they didn't say if it's separate for a non-public company, you have to put that little paragraph. They didn't tell us what kind of heading it has on it. Report, maybe this is the heading. And it doesn't fall into the category of emphasis of matter or other matters. I don't know. Okay, so maybe it just has that heading. Maybe that's the answer. Whereas in the case of the public companies, they're telling us no heading, which is kind of stupid. Why not? Why not have a heading? So if they're separate and there's that paragraph that points, immediately following the opinion paragraph with no heading. Why? Okay, but go ahead and, I mean, that doesn't make any sense to me, but anyway, go ahead. And when I say it doesn't make any sense, it's probably correct, but I wouldn't put a heading on it, but just go ahead and flashcard that. Okay.
I've got Aries Capital's audited financial statements. They're 10K here, and they issue separate reports on both of them, but I think they do that for length reasons because they've got a humongous critical audit matter section in their financial statement opinion that takes up, that's almost a page in length because of all the fair value investment stuff that they're involved in. And then they have a separate page for their separate internal audit, internal control report. So I think length may have something to do with whether or not they do a separate report.
Now that you're saying that, I think that probably, I'm going to stand corrected and say that it is probably the other way. They're usually separate reports because when I've looked around at companies' 10Ks, they're separate. You know, the report on the internal control and the report on the financial statement. So I don't know, Sarita. I'm not sure what triggers that decision, but they have the option. Okay, good. Let's go ahead and let's take a look at the report date. Now, remember, guys, if you're not having a boo, we're repeating ourselves now for public companies, right? So the date of the report on internal control should coincide with the date of the report on the financial statements. So far, I haven't seen anything significant as to why we had to separate these discussions other than the structure of the report looks a little different. But for the most part, the key reporting elements are the same, whether it's a public company or non-public company, okay? Material weakness in internal control just takes one material weakness equals an adverse opinion. If management report fails to include one or more material weaknesses, the auditor will call that out in their report and let those charged with governance know that that has happened. Same thing we said for a non-public company. If management reports includes a material weakness but is not fairly presented, the auditor will call that out in their opinion on the internal control. Again, we said that for non-public companies. Same deal here for public companies, and then the auditor should consider the effect of the adverse opinion on the audit of the opinion on the financial statements. We said that. So when I look at these, I really don't see a whole lot of difference here between what we do for public and non-public companies. Okay. Now, when you come down, reporting on previously reported internal control weaknesses, and they tell us that in some cases, management's assessment of internal control of financial statements may reveal the company has one or more material weakness. If material weaknesses are subsequently eliminated, management may want to have an auditor come in and say, yeah, those material weaknesses have been corrected. If that's the case, then there are specific requirements with that kind of an engagement. Okay, so an engagement to report on whether previously reported internal control weakness continue to exist is a voluntary engagement, and it is not required. It could be done at any time during the year. The auditor's objective is to express an opinion on whether a previous reported material weakness has been eliminated. The auditor may perform such an engagement only if, okay, and let's just go ahead and flashcard the requirements here. He or she has sufficient overall knowledge of the internal control. Management accepts responsibility for the effectiveness of the internal control. The auditor's testing is limited to the control specific identified as management as eliminating the material weakness. And to issue an unmodified opinion, the auditor must obtain evidence about the design and operating effectiveness of the specifically identified weaknesses that have been eliminated. There can be no scope limitations. Okay, now we join the two together to talk about scope limitation. Any scope limitation on the engagement results in a disclaimer. Again, there is no qualified in these, okay? Results in a disclaimer. Any scope limitation results in a disclaimer. You can flashcard that, okay? Come down. Even if you disclaim, okay, any material weakness that you have identified, coming over to the next page, any material weakness identified should be described. So you're saying, but wait a minute, now you disclaimed. Yeah, but if you found a material weakness, you had a scope limitation, you were able to do everything you're supposed to do, you're disclaiming, but you found a material weakness, you have to disclose that. And you have to let management and those charged with governance know that you cannot express an opinion. And the auditor may issue the report disclaiming an opinion as soon as the auditor concludes the scope limitation will prevent you from expressing such. Okay. Okay, good. Come over, and what I want to do is take a look at e-learning, and I bet you they've kicked me out now. Okay, thank you, God. They did not. Let's see if I can make this a little bigger here. Let's see if they'll let me move it around. Okay, can you see it? Might have to put your face up to the screen a little bit. Okay, but take a look. So I have the three types of engagement. I have it for a non-public company. I have it for under SAS. I have it for non-public company under the specific SAS. We saw 130, and I have it for public company under the PCAOB. Okay, now when we're talking about communication, remember, we have to communicate that to management and those charged with governance. So when I looked at this, I said who, when, and who and when is basically what I'm saying. Who do we have to report it to and when? Okay, so first of all, there is no oral communication. Everything has to be what? It has to be in writing, right? Second, written report required on all engagements. No, only if significant deficiencies and material weaknesses are identified, then you have to have the written report. Okay, so when you have significant deficiencies, material weaknesses, it has to be written. If there are no significant deficiencies or material weaknesses, then you can report those not good deficiencies orally. Now we come over, if it is a public company, yes, you have to have a written report. Everything has to be in writing. Okay, written report to management and those charged with governance. Who and when? Management and those charged with governance, there's that 60-day window that we talked about, right? Who and when significant deficiencies go to, control deficiencies go to management within 60 days of the report release date and inform those charged with governance that such communication has been made. Significant deficiencies and material weaknesses go to management and those charged with governance by the report release date. Significant deficiency, control deficiency, I should say, for public company, the not good, goes to management and inform those charged with governance that such communication has been made and there was no time specified. Significant deficiency to management and no time was specified for the significant deficiency material weakness. Didn't they say prior to the report release date or by the report release date?
The prior.
It said prior?
Yeah,
I used to have prior and then I took it off.
it's kind of the same thing as by, isn't it? Sort of. I mean,
it's close enough, but if I'm gonna have this summary table, I think what happens here is they keep changing the fucking requirements on me. They keep saying prior, then they say by and prior, by. Okay, so I guess now it's prior, right? Prior to the report's
what it
release
says
date.
here.
Okay. Okay, good. You come over, report is restricted. Yes, the communication is restricted when we're talking about a non-public company. Obviously, it's not restricted when we're talking about the opinion, because that's the whole point. We're sitting here, we're trying to let the public know what we think about the internal control. So there's no restriction there. It's only when it's the non-public company in a straight SAS audit. Written management evaluation, that only happens when there's the opinion. Auditor evaluates management report. Well, there is no written evaluation in the straight SAS audit of a non-public company. That is required, right? For the public company with the integrated audit, opinion, no for the first one, yes for the other two. What happens if there's a scope limitation, material weakness? Scope limitation equals what? Disclaimer for both. Material weakness equals what? Adverse. Never qualify. Okay, so this kind of went the key elements of what we saw in there because it kind of scattered all over the place. And so you can kind of take a look at this and kind of pick out some key things if you get a little confused on some of the questions or something. So let's go ahead with all that and let's go back to the text. And it's a little annoying because after all that, they give us one question to look at here, but let's go ahead and let's look at this one multiple choice question dealing with the internal control stuff. Oh, sorry, guys, you want the question on. I think I'm forgetting that you're potentially looking at my screen for your question. Okay, now when I look at this question, guys, and again, 10-point area, and I see about half the class practically didn't bother to even try this question. Okay, so go ahead, don't pass the exam. Don't try to figure anything out, and you're not going to pass the exam. Okay, but let's go ahead and take a look at this. And when you look at it, you can pretty much eliminate C and D right off the top. Okay, you look at C and D and you're like, okay, we know we have to report what material weaknesses and significant deficiencies. And so everyone who tried this question, chose either A or B. So then the real point here, the real challenge is to figure out, well, okay, what's going on with this other column? And they say both significant deficiencies result in an adverse opinion, both significant deficiencies and material weaknesses. And it's what? Only takes the one material weakness, right, to result in an adverse opinion. So it's material weaknesses, and we don't put the significant deficiencies in the evaluation unless collectively they morph into, they become the monster of material weakness, right? Okay, so B is the correct answer here. Okay, question? Okay, good. Let's go ahead and let's see if we can get through some of the, get through with module 3 here tonight. So let me go ahead and put it back in full screen, okay? And now we're gonna start to talk about attestation engagements, okay? Now, it turns out that an audit is an attest engagement, okay? What you are doing is you are testifying as to whether or not you believe the financial statements are fairly stated. This has been around a long time. The reason they call it testifying is there was a time when auditors stood out in the public square and read out their findings pretty much because people couldn't read, okay, back in the 1800s and Dickens time and all that kind of stuff. That's Scrooge, Marley and Scrooge was a CPA firm of its time, okay? So what happens? Auditors have been testifying for a long time. Well, around the 70s, people started looking at the profession saying, well, if you can testify about financial statements, why can't you testify about other things related to financial statements or related to financial reporting and whatnot? And everyone said, yeah, that's a good idea. Let's broaden the profession. Okay, but we need a set of standards for that testifying, don't we? Well, let's put it in with the auditing standards. No, let's leave the auditing standards alone. For what? For historical financial statements in which you're auditing, you're attesting to those, you're giving a testimony on those. And then when we get to things outside of the historical financial statements, those will fall under the attest standards. And so that's what we're talking here. We're talking about what? When an auditor gives an opinion and a test, an assurance on something other than the basic historical financial statements. Okay, so go ahead and flashcard that just so you remember what we're talking about when we talk about the attest standards. Okay, now the nature of some of the engagements that are listed here as attest that fall under the attestation standards, agreed upon procedures. Okay, pro forma financial statements, certain compliances, management discussion analysis, reporting on controls or service organization. These all fall under the attestation standards. Now you're like, well, John, why did you orphan financial forecasts and projections there? Well, they can fall under the attestation standards if the auditor is giving an examination, giving an opinion on those statements. But if the auditor is simply preparing those statements or compiling those statements, then those fall under the SARS. Okay, so preparation and compilation of prospective financial statements aren't talked about in the attestation standards. They're in the SARS, but you have this annoying issue that if you actually audited prospective financial statements, financial forecasts and projections, then you would be under the attestation standards. So they decided to just put it all here under this discussion, anything related to financial forecasts and projections, commonly known as prospective financial statements. Okay. Okay, good. Now you come over, and I think it's worthwhile to go ahead and flashcard what kind of things you can do with these different situations. So prospective financial statements, under the attestation standards, you can examine them. You can prepare them, you can compile them, but they're not listing that here because that's under the SARS. You can perform agreed upon procedures, and agreed upon procedures, guys, is basically the auditor, the accountant, the CPA, and the client, what procedures are going to be performed. That's not the case in an audit. In an audit, we tell them what procedures, or we don't have to tell them. We decide what procedures we're going to perform. In agreed upon procedures, there's a negotiation back and forth between the client and the professional, the CPA, about whether or not they're going to what procedures they're going to perform. You cannot review prospective financial statements. Okay, you can do a review of the pro forma statements, and then you can have examination on compliance. You can examine the MD&A, you can review it, and then the service organization engagement is considered an examination. Okay, so flashcard that, and then let's go ahead and take a look at the areas where the statements don't apply. Okay, audits and preparation, compilation, and reviews of financial statements of a non-issuer are done under the SARS. Okay, that's of financial statements now. Okay, so when we're dealing with the financial statements, if it's an audit, we have the SASs. Okay, and if it's a, might as well put that in there, SAS. And if it's a preparation, compilation, or review of financial statements, that falls under the SARS. These are the historical financial statements they're talking about here. And we've also seen that the preparation, compilation of prospective, forward-looking financial statements also falls under the SARS, whereas an examination of prospective financial statements falls under the attestation standards. Okay. Now, when they, just to emphasize, attestation standards don't talk about historical financial statements, and that's under the SASs. And they don't talk about generally accepted accounting principles. Okay. Now, you come over and they give us the high-level mnemonic to remember the, what is it, 1, 2, 3, 4, 5, 6, 7, 8 standards for attestation engagements. Just flashcard that. I'm not going to go through what these are, just flashcard and use that mnemonic. Okay, I don't see really any questions asking you generally about the standards for these kind of engagements at a high level. They don't even ask about the standards anymore the 10 generally accepted auditing standards for audits, let alone get into these 8 for whatever it is for attestation engagements, but do have a flashcard. Okay, now when we get to the discussion here about additional reporting requirements, let's go ahead and take a look. And when we're reporting, okay, we may either report directly on whatever management is asserting in the thing that we're giving our attest to, or we could attest we could attest to management's assertion, or we could attest directly on the subject matter. Okay. For example, let's say we're attesting on some report that management prepared that shows fair value or something, and they want an attestation on that. We could say the accompanying schedule, management's assertion about the accompanying schedule, or we could say we have it examine the accompanying schedule. Okay, so you can speak directly to the subject matter, or you can speak to management's assertion on the subject matter. In either case, management has to present an assertion. Okay, they must present an assertion. The auditor has to make them present an assertion of whatever they're saying about that. Okay, now if there is a weakness or deviation from whatever the criteria is for what they're giving the assertion, then the auditor has to report directly on the subject matter. Okay, so you can either report directly on the subject matter, or you can report on management's assertion about the subject matter. If you find some problem, then you have to report directly on the subject matter. Okay, if reporting on the assertion, then the assertion should accompany the practitioner's report. If you're going to report on the assertion, then you have to have it with your report. So let's just flashcard all these elements right here. Okay, good. Now you come over and scope restrictions. If we, during an examination and audit is an examination, but we don't call it an audit when we're looking at something other than the prospective financial statements. We call it, other than the historical financial statements, we call it an examination. And if there's some restriction on that, then we have all the options. We can qualify, we can disclaim, we can withdraw. Okay. If there's a restriction in a review, then we have no choice but to withdraw. Okay, if there's a restriction on the review, we have to withdraw under the attestation standards. If there's an examination, then we can go ahead and have the full scope of, qualified, disclaimer, or withdraw from the engagement. Okay, let's go ahead. Let's take a look at this question. Oh, you want the poll, right? Okay, guys, I'm going to go ahead and end the poll here because it looks like just about everybody's already answered this. Maybe one person. Okay, now it looks like everybody answered it. And good, excellent, good work. Okay, that's 100%. That's everybody. And the way to look at this question is, well, look, if I'm talking about the attestation standards, I'm talking about engagement that doesn't involve the historical financial statements, right? Okay, so when you start looking at that, well, audit of financial statements, I don't care if you were auditing statements prepared and used for another country, we have already seen how the standards cover a report like that, right? So no, that's not under the attestation. Report on, there's that phrase, financial statements again. So no, that's not under the attestation standards. And then you look at C, provide the client with financial statement. The what? The financial statement phrase was in every single one of these except B, where now they're saying, hey, you're looking at and you can review the MD&A. You're looking at a review of the MD&A. Yeah, now we're talking about something outside of the historical financial statements, and you can examine the MD&A, you can review the MD&A. Okay. Okay, again, now, if it is an examination, examination provides positive opinion, okay? You are saying, in my opinion. That's why an audit is an examination, because you give a positive opinion, don't you? You say, in my opinion, the financial statements are fairly stated, but now we'll be giving an opinion on something other than the historical financial statements, whatever it is. Perhaps we're giving an opinion on prospective financial statements, okay? Now you come over and they give us an example report. Oh, I think this is worthwhile. So this is an example of examination report directly on the subject matter. We have examined the accompanying schedule, whatever, okay? And then you say, in our opinion, the schedule of investments, whatever it is. And so you speak directly to the subject matter. If you are giving an opinion on about the assertion, you say, we have examined management's assertion, and then you identify whatever the assertion is, and then you say, in our opinion, management's assertion. So those are the two choices that you have as to how to report that. Just remember that if you are going to have to modify your opinion, then you have to report directly on the subject matter. Okay. Okay, good. Now, if it's a review, they say has limited assurance. In other words, negative assurance. So what you say is, you say, hey, I'm not aware of any problems. So instead of saying, in my opinion, they have, prepared that schedule, whatever it is, correctly, you say, I am not aware of problems. Which one makes you feel better as a user?
What do you mean?
Well, which one makes you feel better if you're a user of the report? I write a report that says, in my opinion, this chair will not collapse if you sit in it. In my opinion, this chair will not collapse if you sit in it. Negative assurance is what you get in a review. I say, I'm not aware of any problems with this chair that should cause it to collapse. May you sit in it?
The first one is better. Right?
Okay, the first one is better, right? So then you're like, well, why would anybody ever want to review? Well, it depends. If the chair is 2 inches off the ground, maybe it doesn't matter if you're not going to get hurt that bad if it collapses. If the chair is 50 feet in the air, you're saying, no, give me the positive. So it really depends on the objective of the users, right? As to whether you get a review.
Reviews are a lot cheaper than audits.
Yeah,
Reviews are a lot cheaper than audits. And for a small company, if your bank will accept a review, you'd want to do that instead of an audit.
Correct. I mean, again, the bank is the user, right? They're determining what they need for their purposes. And if they are satisfied with the review, yeah, why would you do a full-blown audit? And we'll talk about reviews in chapter 6. Okay, we'll talk about reviews and the requirements around reviews in chapter 6, but they're kind of mentioning it here because now we're under the attestation standards. And for some of the items that are not the historical financial statement, you can review them. And that's why they're mentioning it here. Okay. Gets a little hard to follow everything. I realize, guys, that it's just the nature of the subject matter. It's just hard to kind of put it all in one place. Okay. Okay, good. And then if you have agreed upon procedures basically involve an agreement between the CPA and the user as to, I mean, not the user, the CPA and the client as to what procedures will be performed. And we're going to get to that here in a couple minutes. Okay, in fact, we're going to look at it right now. So let's just go straight to agreed upon procedures. So you come over, and when we look at agreed upon procedure, what's happening? Let's say let's pretend I'm a CPA, which I am. Okay, so we don't have to pretend. Okay, so I'm the CPA in this, and let's say Serena, you want to make a loan to Andrew, and you ask for some sort of reporting from Andrew. And I say, you call me and you say, what should I have Andrew do? And I say, well, you could have him issue a set of financial statements and I could audit those. And then you have the assurance you can base it on. You say, we don't need to go that far. I just want some sort of reporting. And so you and Andrew agree that what you'll do is you'll have the beginning balance. Maybe I even suggest this of the accounts receivable. Let's say you're going to base the loan entirely on the account receivable. So you don't want to go through a full-blown audit. And so we have the beginning balance of the accounts receivable. Okay, you're going to base the loan on the account receivable. We'll have some sales. We'll have some collections. And we'll have the ending balance. And I tell you, hey, look, what I'll do is I'll send out some confirmations for the ending balance. I'll go ahead and I will, vouch some collections to the bank statements. And when I send out the confirmation, I'll pick some larger sales that occurred throughout the year and I'll ask them to confirm that as well. And you know what, guys? I'll throw in the beginning balance for free. Okay, now you look at that and you say, okay, well, look, you have the ending balance and you're cool with that and the collection sale. Yeah, I get the beginning balance. So I say I'm going to do all that. And you guys say, no, I don't think we have to do all that. So I tell Serena and Andrew, okay, you guys figure it out. What do you want me to do here? And so they come back to me and they say, we really just want you to look at the collections here. That's good enough. And I say, but how will you know then? Shut up, just do what we told you to. That's what we want done. That's an agreed upon procedure. You guys directed my activity and I then agreed to go ahead and do that work. Okay, so in order for me to be able to do that kind of an engagement, agreed upon procedure, okay, I have to be independent. Okay, and I am sure is the mnemonic here, although I don't necessarily care about every single one of these elements of I am sure, so I only expect you to flashcard the ones I highlight. Okay, there has to be independent of me, the practitioner. There has to be agreement of the parties. Andrew and Serena have to agree. There has to be something measurable. Okay, I think that measuring the collections, that's something measurable, right? The sufficiency of the procedures is to the client takes responsibility for the sufficiency of the procedure. Serena, Andrew, you guys are responsible for the sufficiency of the procedure because you told me what to do, right? If you ask me, I'm thinking you should have done this over here, but you guys decided you wanted something else. So I'm not responsible for the sufficiency of the procedures. You guys are. You directed me. Use of the report is generally going to be restricted, okay, to the specified parties, okay? In other words, we don't want Kathy picking up that report and say, well, I'm going to lend Andrew some money too, because, you know, this looks good to me. Meanwhile, she wasn't there when we had the whole discussion as to what it was that the procedures were supposed to entail. Okay. Okay, good. Now, flashcard, those ones that I highlighted, and then let's come over and let's look at the reporting elements. Okay, and let's flashcard the specific reporting elements that I highlight here. Okay, so in the report, in my agreed upon procedure report, I will have to make a statement that the sufficiency of the engaging parties where is it? I don't think that's the one I wanted. One second, guys. 1, 2, 3, 4. 1, 2, 3, 4, 5. Yeah, a statement that the engaging party acknowledged that the procedures performed were appropriate to meet the intended purpose for the engagement. So the engaging party, in other words, Andrew and Serena in this example. Okay, a statement that the report is not suitable for other persons. Kathy, this report is not suitable for you because you weren't presumably there for that discussion. It was between Andrew and Serena. You know, go ahead and put this down because the AICPA is in love with themselves. And so you would say that you had performed the procedures under their requirements. A description of the procedures performed and any related findings. There is no opinion. So I'm going to say in there, I selected 10 cash collections included in the cash receipts journal and vouched them to bank statements. And that's all I'm going to say, that I did it 10. Or I sampled 10 and I was able to vouch 8. 2 I couldn't vouch. I selected 10 and I was only able to vouch 2. And that's all I'm going to say. Say, therefore, that means, Serena, don't loan Andrew the money. No, I don't say that because you guys told me what to do. You should know what that means, and whatever that triggers in your decision is up to you. So I simply list the procedures, what I found when I list the procedures, and I express no opinion. I don't draw a conclusion. Okay.
I have a question. Earlier you say, the engagement is between me and Andrew, but the auditor find the result.
No. The engagement is between the engaging parties and the auditor.
Okay.
And you direct what procedures you need me to do.
Okay, and then your finding is neutral. Is you find
I tried to trace 10 cash collections of the bank statements, and every single time there's a collection listed in the cash receipts journal, and I couldn't find a bank that it got deposited into the bank.
Okay, and then why earlier you said why Kathy cannot use that finding? She find the information.
Because if I said that I traced 10, you know, that I found 10 and I found all 10, she may look at that and say, well, that's great. Meanwhile, there was a whole conversation about, hey, maybe confirmation would be a better procedure, right? Okay. You guys agreed to have me do 10. You know, I may be sitting there saying, this is ridiculous. Serena should not accept giving a loan to Andrew based on these procedures. But it's not my business. But I can't have everybody in the world grabbing my report and making decisions based on it. So it's restricted to those that know about it, know what it was that you guys were satisfied with. It's you guys decide what you want me to do, and you engage me to do it.
So you don't have responsibility if, for example, I loaned the money to Andrew, I lost the entire loan. you don't have responsibility at all.
Well, look, if you loan money to somebody and that you lose the money, he doesn't pay you back, you know, you would have to point, and you relied, say, on the financial statements for that, where I selected the procedures, then you would have to point to something I did wrong that led you to that decision to have some sort of, privy against me, if you loan him the money and it looked good going in, and then it turns out, Andrew was trying to open up a restaurant, and it turns out he's a horrible cook and he poisoned 20 people, with his, well, they can't come after me for that. What am I supposed to do? I didn't know where my report did say this restaurant is wonderful. Okay, now, in the case of the agreed upon procedures, since you directed the procedures that were sufficient for your needs, yeah, no, you cannot come back after me, because I told you to let me confirm the accounts receivable, and you guys said no. What do you want me to do now?
Does that happen often? Do client requests just to do one stuff collection, doesn't go through the whole process?
Well, no, this is just a simple example. I don't think that somebody does it, is this careless about, making a decision like this to loan somebody money just simply based on collections. But there are some situations that are so unique that it makes sense for the parties to agree as to exactly what it is they need done. And that's what they bring the person in to do.
I think you might see this in a merger and acquisition context, where a CPA is being brought in, and let's say Andrew's selling his company to you, Serena, and you would agree that this CPA is going to do certain procedures that would not disrupt Andrew's business, but would give you, Serena, the comfort that his representations to you with respect to the business are accurate. I mean, that might be an example where you would use agreed upon procedures. We do it in business valuation when we're doing a calculation between, say, friendly parties, like someone's doing succession planning and they want their junior partner to be able to buy in. And everyone's on good terms. There's no dispute or anything. So everybody agrees what are the procedures that should be done, or what valuation methodologies and things we should do. And we go and we do those. And that's an agreed upon, it's not in a test engagement, but it's the same kind of thinking where the parties agree because it's specific to their specific needs in the circumstance.
I see. Thank you.
Yeah, I think, in the context of the government, the GAO has some specific agreed upon procedures that they do as it relates to certain excise taxes. So these kinds of things come up, where it's a special type of engagement. I just use this simple example of a loan. The reality is you'd probably have me do, if you were going to base it on the account receivable, you'd have me do a specified line item, and I'd give an opinion on that line item. And if I would get an opinion on that line item, I'm going to tell you what I'm going to do. I'm going to do what I need to do to give that opinion, but that's not what we were talking about here. We were just saying you want to base it off of a specific procedure, set of procedure that you chose. I'm just using a kind of simple example. Okay, all right, good. So let's go ahead and take a look at, okay, I thought we had a question there, but we don't. But we do have some time left, but not enough time to properly go through prospective financial statements. So let's go though to the question that deals with agreed upon procedures, and then we'll come next time to look at the other question that's the end of this module that deals with, I think deals with prospective statements.
Yeah, I think question 1 actually really explains the circumstance when you'd have agreed upon procedures.
Okay, all right, good. So let's look at question 1, and I'll go ahead and put the poll up. Okay, guys, I think almost everybody's had a chance to look at this one and just about everyone got it right. I don't know if somebody picked C by accident. Maybe they're trying to hit B, because I can't quite understand why someone would think C would be right here. If someone wants to chime in on that, I'm all ears, but let's just take a look. Mill CPA was engaged by a group of royalty recipients to apply agreed upon procedure to financial data supplied by Modern Company regarding Modern's written assertion about its compliance with contractual requirements to pay royalties. Mill's report on these agreed upon procedures should contain, there was nothing that we said about disclaiming information on the financial statements. So that's just complete. No, I mean, the ones that are wrong are just wrong because they're wrong. B is the correct answer. List of the procedures performed and Mill's findings, whatever procedures they performed, and what did they find when they did that. I traced 10 deposits from the cash receipts journal to the bank statements, and I was able to trace all 10. I sampled 10, I wasn't able to trace any. Whatever it was, right? I list what I did, what I found, okay? Option about, opinion about the effectiveness of the internal control, and I'm just like, huh? I don't know what to say about that one. Acknowledgement that the sufficiency of the procedure is solely Mill's. No, it's not Mill's responsibility. It's what? It's this group of royalty recipients in Modern Company, I guess. They're responsible for the sufficiency of the procedures, not Mill. Mill is the CPA. Question. Okay, so what we will do next time is we will wrap up chapter 5, and we may even have a chance to start to get into chapter 6. I do need you to make sure that you looked at the back end of that recording for chapter 4, and then you're able to look at some of the internal control stuff as in the back of chapter 4 and the internal control stuff that we looked at here today. So you should be good all the way up through module 2. I'd say hold off on module 3 for this chapter until we've had a chance to come back and complete everything else. We looked at the general stuff and agreed upon procedures, but you're gonna see questions about prospective financial statements. You're gonna be, what is this stuff? We haven't talked about it yet, so I'd hold off on module 3, and I'm sure you've got plenty of homework to keep you busy while you're waiting for us to cover that. And then we'll finish chapter 5 next time, and maybe even knock out a couple modules of chapter 6. Question? Okay, guys, have a good rest of the evening. Make sure you're getting through your homework. You might want to strongly consider attending that Ascend event tomorrow. Who knows, you might be the lucky recipient of the Becker material you can give to your little brother or sister. Okay, guys.
Thank you, Professor.
Thank you.
Good night.
Good night.
Hey, I just wanted to apologize for so late, John. I just got held up at work.